Welcome back, guys, to another Zero DTE podcast, and today we're on Season 2, Episode 31, where Ernie talks about profit taking, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's course. And as always, I hope you enjoy, guys.
All right, friends, how you doing? Ernie here, and this is the 0 Days to Expiration podcast. Let me just tell you something about the service and where we are. If you're watching this, you probably already know that what we do and all that. But what's happened over the past month is really exciting. The explosion of new customers has been very exciting. We went from attracting 3 to 5 new people every day to 10 to 20 new people every day. And so that's presented a whole list of challenges which we are dealing with and trying to automate and all that other stuff. And while I was doing that and hiring new people, all kinds of stuff, the thing that lacks is the ability to put out some things. So one of those things that suffered was that daily show, and I'm really sorry for it. But today, we are going to make up for it all by doing something very special that I know that everybody is interested in, and that is taking profit. We all love taking profit! Yes! So I'm going to go over that, and it's going to be a whiteboard session today. So before I begin, I want all of you that are not familiar with the service to understand exactly where we're coming from, what we do here, etc. And I keep on looking over here because I'm amazed at the move that Tesla has made in the market today. Whoa! Unbelievable! Let's see, has the rest of the market is also starting to take off. This is fantastic. But we're not there on a full breakout yet. We're looking forward to that. Wow, Tesla is up, how much since the beginning of the day? Is it really that much? No way. Wow. Let's see, I'll have to compress it a little bit. And since the open, not bad. Up like 5% or near 5%. That's pretty impressive. All right, I expected to go much higher. Do we know what triggered Tesla? They've announced that they're introducing a new Model 3. There were also a number of people that took a tour of some of the plants, the Gigafactory in Texas, and I believe that was the primary one. And what they saw there, they said, of course, they're held to secrecy, but what they saw there, they said was incredibly exciting. So the only thing that I can imagine that is so exciting, there are two things. One is that they've started production of the Model 2, which is their low-cost, under $25,000 EV. And then the other thing is the start of production of the Cybertruck. All of that has to be, let's see, can you remove the starting thing? Yeah, I think I can. Hold on. So we go to the new scene, which is this scene. This is the new scene. There we go. I think I got it now. All right. Yeah, big things coming from Tesla. So let's get started on 0 DTE, 0 Days to Expiration, and that's what we do here. This service is all about coaching and mentoring and helping traders become consistently profitable, independent, and trade at a pro level. That third part, trade at a pro level, is so important. This is a coaching and mentoring service where we help day traders achieve those 3 objectives. Now, it's very different from your average retail trading service because this is not a retail trading service. I am bringing my professional experience in this as an institutional or former institutional trader, hedge fund manager, and current CIO of a 9-figure family office fund, bringing that expertise here for you guys, helping you achieve that level of professionalism so that you can become consistently profitable, independent, and trade at pro level. And we choose the 0 DTE event as our primary rallying point and where we bring all our strategies for a number of reasons. One of the 2 primary ways that most pro traders make money is by collecting premium. And the 0 DTE event is the day or the period of time where you're going to have the most premium decay or premium available to collect in the shortest amount of time. And so then we combine that with asymmetrical principles and also a process with a framework for collecting that premium. And that's what I'm going to talk about today. I'm going to talk about that framework and how we go about that. All right. So first of all, our primary thing to do to get or implement the asymmetry and premium collection is our go-to strategy, which is the out-of-the-money butterfly. Now, what that means is that unlike the way most people think of a butterfly where they choose to trade it at the money, in other words, they'll take a very wide butterfly and then put the short strikes right at the money, and then hope that the price doesn't move one way or the other and try to collect as much premium as fast as they can. And while that strategy can work in some market environments, today, that would not be a strategy that you would want to employ today because you would be a big loser. Plus, you're not gaining the real advantage of the butterfly. And that advantage is your ability to really control your risk to reward. Now, if you want to be a pro trader, and what I know of most pro traders and most pro investors is that they're after capital efficiency. And what that means is that they want to make best use of the capital that they put at play and have the potential for the maximum potential profit. That may have been redundant, but that's what we're after. We're after small risk, large potential reward. And the reason for that, why we want to take that small risk, is so that we can control our drawdowns, so that we can control our capital expenditure, so that we can make the money that we put and invest as efficient as possible. So that when we lose small. When we win huge. It also allows us or opens us up to a path to scaling our strategy. So there are so many benefits to trading this way, and it's the way I've known for 20 years how most pro traders trade. Take the least amount of risk or limit your risk to the smallest possible reasonable amount and open yourself up to the potential for the largest potential trade. That's what we do every day. And as I said, with the out-of-the-money butterfly, that is our goal. Now, we have certain standards that we start at in terms of asymmetry. We want to put on trades that have at least a 1-to-9 risk to reward. And the way we come to that is by employing I guess you could call it an age-old strategy from the old-time options traders. When they would put on a butterfly, they would use something called the 10% debit rule. And that meant that whatever the width of the fly was, they made sure that their debit was no more than 10% of that width. So for example, let's say you put on a 30 wide butterfly. Now, when you say 30 wide, you're really referring to just one of the strikes. So it's a symmetrical butterfly or one of the spreads. It's a symmetrical butterfly. So that means that in reality, it's as much as 60 wide. But one of the spreads is 30 wide. The other one is 30 wide as well. And then you would push it far enough out of the money so that the debit of that fly never exceeds 10%. Now, when you calculate the profit potential of a butterfly, the way you do that is you take the spread width and you subtract the debit. So if you have a 30 wide and you make the debit 1/10 or $3 and subtract that from the 30 wide, you get 27. You multiply that by 100 because that's how it works. That's the multiplier factor. And then that fly, that 30 wide fly, has a potential of $2,700 profit for a $300 risk. Now that sounds pretty outrageous, right? The chances of you actually getting $2,700 are relatively small. You can get somewhere close to it with about a 5 to 7% probability of profit. And you think, that's not so great, Ernie. If I only have a 5 to 7% probability of profit, why would I trade that? That's not the only possibility here. You can make a whole spectrum of returns from $0 to $2,700. In fact, the odds of getting anywhere from a 100 to 200% return are very high. The odds of making, say, a 300, 400, 500% return are also very high. Getting that very highest obviously is not going to come across all the time, but it does come every once in a while, and you can make that, and that's what you're shooting for, hopefully, but you can't rely on it. So we're not about high probability trades here. What we're about is what that all relates to or turns into in terms of return. Return is our ultimate arbiter. And the return on such a trade is really fantastic. Profit your profit factor is very high. Your average return or average winner versus your average loser is typically 2 to 1. Now, your win rate may only be just 50%, 55%, or something like that. Now, of course, if you thought that you were a directional maven and you could tell where the market's going 80% of the time, your returns would be outrageous. But we all know that's not based in reality. Most people have no idea which way the market's going. And in fact, we play the market in that way. So you may think, well, that also means that you could lose a lot. Yes, it certainly does. But here's the really cool part. When we make that risk very small, we are defining our risk. And we don't really spend a lot of time trying to manage that risk. As a matter of fact, we don't spend any time at all. That is our risk. And so that's what we're willing to lose when we put on that trade. So if we are capping that risk to that 10%, now, of course, this is the maximum size that we would ever make that risk. Let me just keep that in mind. Then we're always guaranteeing that our risk will never get too big. We'll never have a big drawdown. We'll never have a catastrophic loss. Of course, if you lose many times in a row, of course, that will add up. Sure. What are the odds that you're going to lose before you actually have enough winners that are going to compensate for that and then bring you over the top? And that's where what we're going to talk about, how you actually capture that profit. Now, there are a number of ways that you can do that. One is be directional and put on that fly. If you think that you have a good bead on direction, then you're going to do very well. And there's a lot of stuff that you have to take into consideration when you're in a premium collection trade. Probably the most important thing is that premium is decaying throughout the day. And unless you're inside the fly, you're not going to be able to take advantage of that premium decay until it's maybe at the end of the day, right? But from the start of the day, that premium curve is not limited to the boundaries of that butterfly. As a matter of fact, it spreads way, way, way out. Just think about this. When you first enter the trade, you're entering it way out of the money, maybe like this. And I'll show you this in a second. If it starts moving towards your trade, you're immediately in profit. The cool part is that because you've taken such a little risk, it doesn't have to move very far before you're receiving substantial profit relative to what you think you would normally get. You wouldn't have to move too far before you're at 50, 100, or 150% return. Now, wouldn't you like to make 100, 150% return? Of course you would. And it turns out that the vast majority of our trades return somewhere between 50 and 250%, which is just outside of the profit tent of that fly. And so that represents a good portion of our trades, and those trades tend to totally offset our losses. And that means that so now that those offset our losses, what is left are those trades that get very close to or inside of the profit tent that make way more than 200 or 250%. They can make 300, 400, 500, or even 1,000% return. You get those, and now you start really multiplying your returns. The key is how you actually hang on to that profit. Price could be moving all over the place. You need to have a very specific framework that is taking into account the premium decay, the time of day, your position relative to the strategy, all of that. And then you need to practice a process that would guarantee some level of consistency in order to take those profits. All right, so that's like big picture and how we do all of this. Deathly Gaming says, excluding most of this month. So what he's saying is that this month has been tough. Not most of it. There have been some good days where I've made fantastic profit, but a good portion of the days we had no range at all. So we never really moved towards our profit tent. And so although it would move a little bit and then move back, but then there are other days that really moved significantly, like today, moved right inside of that profit tent. You had huge profit-making potential. And that's the way it goes. The last month really has been an anomaly. If you look at the last month in terms of the number of doji days or days with very little range at all, there were more doji days in the past, say, 3 weeks than there have been in the past 10 years of any other similar period of time. Yeah, there's no doubt that the past few weeks have been really trying. And a lot of that has to do with the activity that's going on with the Federal Reserve, I guess the budget deficit and whether or not they're going to come to a new deal. But everyone's waiting in stasis for something to happen, for something to break. And the market wants to take off or go down. Doesn't matter. But in between that period of time, there has been small periods of time where we've had nice moves up, nice moves down, like today, for instance. However, yes, there have been an inordinate number of days that have had hardly any movement. And to illustrate this, I'm going to show you my chart so that, look, this is just part of trading too. You have to understand that there are days like this. You have to implement your strategy, be consistent with it, make sure you always take small risks. Then moving through times like this are very easy. And even with times like this, if you're in the game and you're ready to take profit, when you do get those big moves like today or some of the other days that were peppered inside of that rough period, you can make really excellent profits that would totally obfuscate all of those no profit days. So that's the cool part about it. And the other great part is that you never really draw down that much because you're taking such defined risk. So what I'm going to do is show the, let's see, go right here. We'll show the chart. So Stefan says, we've been in low expected move territory since March, but I don't pay any attention to expected move, but that is accurate. Okay, so I have some price action stuff here. This is plotting out potential moves for today. So let's take this off so that we can see what we're dealing with. All right. Now, the first thing I want to point out is that what we're looking at is the SPX. And this is over a year's worth of data. So going all the way back to the beginning of the summer of last year. And so you can see very clearly that we've been in this massive consolidation where we're in this big triangle and just consolidating down to some eventual inflection point, some point where the market's going to do something. That's because the market expected something to happen here. This is all timed on the market kind of expecting the Fed is going to finally resolve down to whatever their maximum rate hike is going to be. And somehow the market creates this massive pattern that anticipates it would be right around here. Now, in the beginning of the year, I also anticipated this and drew this triangle around the February timeframe, somewhere around January, February, somewhere around here. And I also felt that we were about to hit a inflection point. And so back then I drew this circle saying it's going to be somewhere in here. Now, it looked like we're there, and there's been many false narratives, false signals that have led people to believe that there was some sort of conclusion to the Fed's rate hiking. And that's what we get when we get these big candles, these up and down ones. We get these ideas that something's going to happen, and then that hope goes away, and then we go right back to the sideways action. But as you can see, we went sideways for quite some time, and Deathly Gaming is actually very correct that we started, I would say the beginning of April, not really March. Beginning of April, we started just moving sideways. And you can see all these little purple arrows are pointing to these tiny little no range days. And if you look at the cluster of them and compare that to any other time going back, you'll realize that there's been more of those purple arrows in this short period of time, not only in just this past year, but if you go back 10 years, 20 years, I've never really seen this many small range days all clustered together. And so those make trading very difficult. Of course, the ranging days that we see, the big red candles and the big green candles, those are a different story. That gave us some reprieve and you can make some really good profit, but then back to this other type of behavior. So this has been, I would say, on average, in terms of trading opportunity for this period of time over the last 2 months, all of April and May, I would give it on a scale of 1 to 10, maybe a 3. There has been opportunity. And in fact, I've made money throughout this entire period, although I haven't traded as much in this entire period either. But that's another story that has more to do with how busy that I've been in managing a much larger service. But I've missed out on a lot of trades. Today, I missed out on today's trade. I wish I had gotten into it because that would have been a fantastic winner for me, more than likely. But anyways, it has not been the best of times. Now, what's great about things like this is that the market is always changing. In fact, the one thing that we can absolutely guarantee that is an absolute constant in all of trading is that change is a certainty. And I know that seems oxymoronic when you say the one constant in trading is change, but that's exactly what it is. Now, we've been doing something very similar for quite some time. However, you can also see that we're starting to curl up here. And that's why I had this little curve indicator here, or this line that I drew in here to say, it looks like we're starting to break out into some open air territory. So what I mean by open air territory is that if you look at these two coral lines, they are put there for a purpose. They are showing where there's a very large volume node. And if I were to go back to the E-mini S&P, which is basically showing the same underlying market, and you can see, I have to go to a daily chart so that we can see the same thing. These purple lines are the same as these coral colored lines, right? So if you look at these coral colored lines and then look at the purple lines, they're the same thing. And you can also see the big consolidating move, all right? So I'm very keyed in on this activity happening here. Let me just get rid of some of these arrows. I'm very keyed in on the activity here because when we break out of this big volume node, which we have been going basically sitting inside of for quite some time, now we're just starting to break out and coming up to this big volume. You'll see that there's very little volume up here. And let's see, we can bring in more of the market here so that we can see that there. Okay, so you can see that compared to this huge volume node here, there's very little volume in this area here. And once we break out of here, we're going to quickly move up, maybe 100, 150 points. That's what's looming here. And so that's what the market is waiting for the Fed. And so what I anticipate, actually, I talked about this even way back here, was that I felt that we were at the precipice of a melt up. And right now we're in stasis, going sideways, waiting for the Fed to come out with their proclamation that they are either done with their rate hikes, or this will be the last one, or maybe they're going to do a pause. Once that happens, I believe all of this wound up, I don't know what you would call this, wound up energy is going to break and we're going to move much higher. I even believe that there's a potential for going as high as maybe even creating an all-time high. That's how wound up I believe the market is, and it's ready to go. Now, if that happens, or I'm more apt to say when that happens. Now, for us, it doesn't matter whether it does that or breaks down because we can trade any of that event. What could be worse is if the market decides to go back into this volume node and just hang out there again because the Fed is sitting on their ass and not taking any action. But I think that most of the market feels confident that the Fed is getting to a point where they must do something. They've really hit the market hard with their interest rate hikes, and they've started to break things like employment and banks and other aspects of the economy, that something has to give. And the stated purpose that the Fed has said all along is that they're going to keep on pushing rates higher until they break something. Now, they're certainly at that point. Now, whether or not they want to do another 25 basis point hike or not, I guess that is up for debate. Maybe we can even look at that and see what that looks like. And just give me a moment here, and I'll see if I can bring that into some clarity. So what I'm going to show you here is the Fed Watch tool. And whoa, holy crap. All right. So you may be wondering, why is Ernie saying holy crap? So the Fed Watch tool is the bond market way of predicting what the Fed is going to do on their next meeting. And their next meeting, as of right now, is on June 14th, right here. You can see that right up there. And right now, the Fed Watch tool is predicting that there will be no change. That's what the 76% is, 76 to 24%. Now, why do I exclaim that this is unbelievable? Because just yesterday, it was exactly the opposite. There was a big 76, 77% odds that we were going to raise rates another 25 basis points. That's what this guy over here on the right would represent. But today has been a complete turnaround. Now, is that because there is some idea that the market feels like there's going to be a resolution to the Fed, or is it going to be some resolution on the budget? I don't think it has anything to do with the budget. It has everything to do with the Fed. And there has been at least some inkling from the Fed, and there were some speakers that came out today that are hinting that we may be getting into a pause where they won't do a rate hike and then wait to see what the effect of all their rate hikes will be. Now, from a market point of view, that's as good as saying we're stopping rate hikes. And because once that happens, the bleeding will at least slow down and give them more room and make the cost of money a little bit more palatable. And so with that, they will push this market higher. So that's a huge change when this was exactly the opposite yesterday, just yesterday. So there's some good reason for our move up today. All right, so now you get a big picture of where we're at, and we're about to break out, and today may be the beginning of that melt up. Here's another thing where we broke a pattern. You see these yellow circles that I've drawn here. All these yellow circles are indicating what's called a black candle. A black candle is a reversal candle. And every time there's been one, we've had some reversal. Here, 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 maybe not so much, but it still did a reversal over time. Here it did. And then this very last one, it started to, and even today was down, but then everything turned around based on this newfound belief that the Fed may be pivoting. So there's the first break in a black candle that I have seen in a long, long time. All right. That is very significant there. So I look at that as being a very bullish move. So we'll see how that all transpires as we get deeper into this. All right. So that's important. Yeah. Let's see what's happening with Tesla. Tesla is backing off a little bit. Very interesting. Okay. Why do I keep on going back to Tesla? Because Tesla is the new Apple. Tesla is going to be eventually the largest company on the face of the planet Earth. And it will represent, I think, or be the kind of bellwether for all other markets. And eventually that will be so. I think that you'll find that that is going to be an absolute as we go forward. We're heading into a new era. All right. We're here to look at some strategies. Now that we have our basic outline, what the macro condition is, where we're looking to go, how we actually choose trades, I'm going to go to the whiteboard and start talking about this stuff. All right, let's see. Thank you for all the comments. All right. Let's bring up the whiteboard. Need to mirror it. Mirror display. Okay. All right, as you can see, we've done lots of whiteboard discussions before. So let's start off by creating a new board, and we'll talk about the basic strategy. And so we're looking at the out of the money butterfly, and we'll do that first. We'll start there. So I'm going to create a risk graph of what the out of the money butterfly looks like. Let's say that right here is at the money. So if this is at the money, then we want to put, say, a bullish fly on. And so we want to center it, say, right here, right? And so we push it out of the money. It will look something like this. Now let's say that our fly is 30 wide. that would mean that we would want to push it far enough in this direction so that the debit right here is no more than 10% of 30 or 3 or less. So that's our standard. That would produce a 1 to 9 risk to reward, right? That's what we're ultimately after. I just noticed something that may be showing. Hold on. Yeah, it was showing green screen. Let me turn that off. There we go. I had to turn off the green screen. I was typing in or creating cyan, which is partly green, a risk graph, and that was acting as a green screen fill-in. So anyways, here we are at the money, and what we really want is we want price to go in our direction. So let's represent that by, we want it to go this way. If it goes this way, then we're losers. If it goes this way, then we're potential winners. Now, the other thing that we need to, when we put this trade on, as soon as we put it on, there is a profit, a potential profit, that a profit line that kind of looks like this, right? Where it will break even. And then here are our various points of interest. Okay, so we put this trade on, and what we're hoping is that the price will, again, go in this direction. And if it does, let's say, now when would we put this trade on? We generally want to put these trades on in the morning between the open and maybe an hour after that. Let's say 10:30. That's approximately the ideal time to put one of these trades on. So if we get a trade on here and we achieve this kind of risk to reward, we're doing it with the expectation that price is going to move in our direction. Now, let's say it does, and it moves this way. And let's say that it gets to, let's see, what do we use? Let's use red. It gets to this point. Oh, that's a horrible red. Let's make that nice and bright. So let's say price gets to this point. If it does, then we're going to have some level of profit here. Maybe as much as, I don't know, if this is $300, maybe $150, maybe $200, right? Well, that's pretty good. That's 75% profit. Should we take that or not? Now, it depends on a couple of things. One is, what time of day is it? Is it the morning? Is it the afternoon? Or is it near the close? That'll make a difference. Of course, if it's near the close, I doubt that our profit curve will look like this, because during that entire day, that profit curve is slowly growing. At one point, it looks like this. And then at another point, it looks like this, until it finally goes all the way up at expiration and fills up that butterfly at expiration. So that's another consideration that we have to make, because that profit curve is always growing, and that means that we need to keep on going this way or take profits at opportune times. Now, if we ended up, say, right next to, very early on, right next to the butterfly, say right there, and maybe early in the morning, say 11:30, we had a big move, there wouldn't be much for us to do. We could just sit there and hold on, because by just sitting there, our profit in the beginning might start off at 200, but by the time we get to maybe 2 o'clock, that profit might be $400 or $500. And we also still have the possibility of it moving into the profit tent, where it could make substantially more, or it could go this way, right, and lose money. So you can see that there's a wide range of opportunities. Now, assuming that you're only 50-50 in terms of picking direction, then all of these profit opportunities are going to represent 50% of the opportunities. And so you're going to have to realize that only 50% of the time you're going to win, but 50% of the time you're going to be working on managing your profit. The other times you're going to let it go. Now, that's our most basic strategy. There are other ways that we can do this. We have something called the Batman, where we take a more market neutral or agnostic strategy, where we put one of these flies on both sides of at the money, so that we can take advantage of either direction, whether the price goes up or down. But let's just concentrate on the basic thing and what we're trying to accomplish here. So what you've seen so far is that price is going to continually be challenged based on two factors. One is what time of the day it is, because the time of day is going to determine each one of these little profit curves, 1, 2, 3, maybe morning, afternoon, or near the closing. And where it is, also the slope of that profit curve is going to be very important to us if we're right on it, because that slope is going to change. If we're sitting right in the middle here, right in the middle, we don't really care about the slope at all because there is no slope, it's zero. But if we're on the edge, then the sensitivity to price movement back and forth is going to be very high. That, in fact, is called your gamma risk. That slope of that profit curve is called your gamma risk. So your gamma risk is always changing based on where you are and what time of the day it is relative to the overall strategy. So that's another thing that we have to take into. So this starts getting pretty complex. How do we decide what we're going to do to come up with a consistent way of profiting, assuming that we're in the 50% of the time where we pick the direction right? All right, this is what we do. Let's first of all go back here. And here's a chart that I was explaining earlier, yesterday actually, that describes all of this. So what we do is we break the whole day up and our whole strategy up into a matrix, a two-dimensional problem. And it's actually more than 2 dimensions, but we'll start with the 2 dimensions. And the 2 dimensions that we're dealing with is the time of day and where we are relative to the butterfly, right? So what you're seeing up here is the 1 dimension right here in this row. And then in this row right here, or this column, is our position to the fly. And I'll explain that in a little bit. But here, this first one is the morning part of the session, the afternoon part of the session, and then the closing part of the session. This here is not in profit. This here is in profit, but just outside the profit tent. And this one here is inside the profit tent. So let's take a look at what this positional stuff looks like. All right. So we have, like I said, we have 1 dimension, which is time, right? Which is the morning session, the afternoon session, and then the closing session. The morning session is between 9:30 and noon, right? The afternoon session is from noon to 2:30, and the closing session is from 2:30 to 4. The other dimension that we're looking at, and the reason why we're splitting this up into 2 dimensions is so that we can split up this entire trade, this very complex movement of time and profit curves and position and all this other stuff, and resolve it down to a very simple matrix. And then we can decide within that matrix how we're going to act in each one of the particular areas. So for instance, we can choose how much of a trailing stop that we typically do when we're inside the profit tent and it's closing session, right? Or outside the profit tent and it's only the afternoon session, etc. So the other dimension is position, and that is the position relative to the fly. Now, the way we do this is we use the break-even points. We have the break-even point of the profit curves. Here's the profit curve. So here's one break-even point. And then we use the break-even point of the at expiration strategy. And we break this up into 3 segments. And we call them Zone 1, Zone 2, and Zone 3. So that's what we had here in this matrix. We had Zone 1, Zone 2, and Zone 3. So now we'll know what to do if we're in the morning session. All of this stuff, let's just get rid of this. And I'll explain exactly why we're doing this. So the morning session, let's use nice sunshine yellow, is right here. The afternoon session, we start getting into blue skies, is right here. And then the closing session, let's get into darker skies is right here. So why do we do that? That's a recognition of the change that happens during the course of a day. Remember, I showed you the growing profit curve. It's changing, and that represents the amount of decay that's happening in our options. So we know that decay is happening at a very slow rate in the morning, and then in the closing session, it's happening very quickly. Now, you've probably seen a chart like this. I'm going to do another chart that will explain all this, that shows what the average decay of an option looks like. So let's say that this chart here represents the life of an option. And let's say that this is when the option is created. And then back here is when the option is finally closed or expired. Maybe E is the best word. All right? If you were to look at the premium of that option, that premium starts way up here. And then over time, it's slowly coming down until it gets to the end, and it just drops off like a rock off of a cliff. So if I were to break this up now in our weekly options, these are 8 days long, right? So that means that we have 7 periods that look like this. 1, 2, 3, 4, 5, 6, 7. And this here is the 0 DTE day right there. Now you can see, now this may not be drawn to scale, and it's not. This curve really looks more like this. That would be more accurate, right? So most of the premium is actually decaying in that very last day. So this is very interesting. That's why we're so interested in the 0 DTE, because the amount of premium that is decaying in that period of time is really incredible. Compared to the entire 8 days, we have all of this. So the most premium is decaying in the shortest period of time. That's why we trade 0 DTE. Now, if I were to take that day, that 0 DTE day, and expand it, and then look at the premium decay over just that day, it would look very similar to the week. In fact, it's like a fractal of it. It would look, make sure you get the right color. It would look just like that if we were to just expand the very last day, the 0 DTE day. So what we can see from this is that if we break down what this looks like in the course of a day into the morning session, afternoon session, and closing session, is a very definitive way that price is behaving. So this is the morning session, this is the afternoon session, and this is the closing session. And even this is just a little off. It's more like this. So we can see that in the morning, premium is decaying very slow. It's flat. And so from 9:30 to noon, there's not a whole lot to do in terms of premium decay. We don't have to worry about that as being a huge factor. The only thing that we really have to worry about is price going back and forth. In the afternoon session, you can see that it starts the dog leg. It starts that push down, right? And so there is a different attitude that we have to have, because now we have accelerating premium, and maybe price isn't moving quite as much. Maybe it's settling in during the mid part of the day from noon to 2:30. And then at the end of the day, it's falling off, like going off the edge of a cliff. And that's from 2:30 to 4. We have to be much more diligent about our strategy when we get there. So if we're trying to make hold or fold decisions all along this timeline, the decisions that we make here versus here and here are going to be quite different based on this decay of premium. And so that's the challenge that we have with 0 DTE. So now we have this time dimension. We also have this positional dimension, all right, which gives us this matrix of opportunity where we can develop our strategy inside each one of these boxes. And it's all going to be different. That is going to be different from this, etc., right? And of course, this is going to be different here. When we're in zone 3 in the closing session, the way we behave there is definitely going to be different than the way we behave here. So we develop our strategy based on this. So every day when we make a decision, we have some guidelines that we follow in terms of what kind of trailing stop that we're going to, or what kind of window of opportunity when we achieve a certain level of profit, how much of that are we willing to let go? And it's going to change in each one of these boxes, depending on where we are and when we are. The third dimension, which helps us make those decisions, is a little bit more nuanced, and that has to do with the underlying market structure. What does the underlying market structure look like? What type of volume profile will usually show us that? And also what kind of price action is developing. That may hasten our decision to hold or fold, or hasten our decision to fold. We don't usually hasten a decision to hold. We would love to hold all the way until we get to here, because that means that we're going to get a max profit in that period, right? We'd all love to be in the middle of the profit tent at the end of the day and get a pin trade. That would be the ultimate. Of course, if we're there, we're sitting here, and we get there at the very early part of the day, like in the morning session, what are the odds that we're going to stay there all day until the close? They're not very high. So we have to decide how we're going to treat that. And we're going to have a certain amount of profit, but it's going to be way down here if we get there early in the day. What we're hoping is that we stay contained and that this profit curve keeps on moving up and that we stay here so that we can collect all of that premium. But there's a chance that it could keep on going this way and turn into a loss if we did nothing. So at some point, we have to decide when we get out. And then those are the types of decisions that we make. Now, this is a continuous and revolving process. Every day we have an opportunity. Some days there are negative opportunities and it just nothing happens and everything just goes away because it goes in the wrong direction. Other days it comes into our profit zones and we need to make decisions. Do we hold or do we fold? And we're asking ourselves that throughout the day. Now, you don't have to be watching this all day in order to make these decisions. In fact, you can set up alerts that would alert you when price gets into a certain area at certain times of the day. That will help you make those decisions, or at least alert you to become cognizant or open up your chart and say, oh, I got an alert. We're in zone 3 now. I should take note and maybe I need to take some action or not. Over time, you're going to make decisions. And then every day, you're going to log those decisions. Yeah, let's go back to now that we've gotten all the basics. And then later in the week, we'll talk about this in greater detail. So later in the week, we'll talk about this in greater detail on what are some of the nuances of our decision making. So if I'm sitting here and just spilling our entire strategy to you, not really. I haven't told you about all the nuance to this, the extent to which we make these decisions, the criteria that we use, the underlying market structure, how we actually do the market analysis or the structural analysis with volume profile, our price action theories, and all this other stuff that influence our decisions. That's all part of it too, and I'm going to go over all of that in these live sessions. But the biggest, most important part of this is how you log and journal all of this information on a daily basis, which is absolutely critical. You must log and journal every trade. You must come up with both qualitative and quantitative information that you can use at the end of periodic cycles. And so what we do is we create a continuous improvement loop. Every week, we close that loop by reviewing all of the previous data, not just the past week, but the past week and all the other weeks prior to that, because that data is constantly building and building and building and developing a picture for us that will allow us to see our patterns of behavior. Each time we see that those patterns are positive, we want to perpetuate that behavior going forward. When we see that behavior is starting to get askew, get off base. We want to find out the underlying cause and then institute a new habit building exercise or whatever we have to do to get that behavior back on track. And we do this every week in, week out. As a coach, I'm here to help you stay accountable to this process. This is the professional process. This is what is going to allow you to become consistently profitable, independent, and trade at a professional level. So I hope you've enjoyed this podcast and you got something out of it. If you're interested in joining the service, it's a service like no other. There is nobody else on the internet that is providing this level of education, this level of professional strategies, process, and breadth of tools and strong strategies, all of it, than in Zero DTE. That's zero-dte.com. Go down below, 4-week trial. Hope you all have a great day. Peace.